Hey, welcome to the myfuturesadvisor.com website. This is Bob Maurer. I want to bring to you a brief tutorial on how to read the strategy sheet and then also see how it looks relative to the video updates that we do on the strategy sheet on occasion. All right, so let's get into it. In order to access the strategy sheets, either as a guest with a trial membership or as a member, and we do appreciate the members, you go to the top right of the website where it says member login and go ahead and type in the credentials that you have. And in there you'll see a pretty clean interface, which is the way we wanted to keep it. It has basically four columns, okay? On the far left, it's got the date that the particular strategy sheet becomes active, particularly the starting date of that week, February 24 in this instance. And then it has the latest strategy sheet with the time that it was updated, the date that it was updated, timestamped there. And then also it has the video update of that particular strategy sheet, and it is also timestamped. And then on the right is some other information you can help yourselves to, such as recent commentary or some suggested reading. So to get into the nitty-gritty, first thing you do is you'll click on the particular strategy sheet there and it'll bring up the sheet. So here's the sheet. It shows that the week of 2/24 is the one that you are looking at, and then if you get to the second page, that's where it dives into some of the details of the strategies. All right, a few things here. Number one is every strategy has a number as we work our way through this grid. Then it has the particular trade. In the particular trade, it's always buying one contract, selling another. All right, so in this instance, the first contract is the one that you're buying or getting long. The second contract on the back side of that forward slash is the contract that you're selling or getting short. So in this case, it's buying the September 2019 crude futures, selling the December 19 crude futures. Okay, I want to hop down one row. Let's go look at 933. All right, so in this case, it's buying July 19 cocoa, selling May 19 cocoa. All right, then it has the margin requirement. Margin requirements do change, can change, and often do change with spreads. So prior to getting into any trade, relative to your account size, confirm at the exchange level or give us a call to make sure this margin requirement is still accurate. All right, and then the next two dates are the seasonal tendency window. So in this particular one for cocoa, approximate start date was Feb 19, approximate end date was April 4, and the difference between the two dates is 44 days. Okay, so that basically is the first part of the trade where it shows you the strategy number, the actual spread itself in terms of which commodity, which calendar months example, and then margin requirement, entry date, exit date, quantity of dates. Back side of this, the right side of the data here, is the nitty-gritty in terms of entry and exit and risk and reward. Okay, so under entry price zone, and here's what you do too. On the left here where it has the actual strategy number, if you click on it, it'll take you down to the chart that we have posted most currently in this particular strategy sheet. So let's do that real quick. So let's go for this cocoa spread. Let's go down to 933. If you just click on it, it'll bring you to the appropriate page. I'm going to expand this here so we can see a little better. All right. So here we have it. Again, it shows the strategy number up here, July 19 cocoa versus May 19 cocoa. And then bottom here, it has all that same data, okay? So what you see here is you get a visual of the actual spread relative to the entry and exit and risk and reward data. So let's just go over that real quick on the bottom. So back down to the entry price zone. It shows two levels, 10 and 15. All right, so what this is if you're a pure pullback trader and you don't want to be an average in opportunist, then you would go ahead and look at that first number. So it's recommending that you try to pick up the spread at a level of about 10. All right, if you're an average in trader, meaning you're willing to take advantage of an opportunity we see in a particular spread where it seems like a reasonable opportunity to get into a position, a multiple contract position, and average in, then the second level would be the average price that would result if you do the average in scenario. Okay, so it's not saying get in at 15. It's saying get in at 10, get in at the average in entry level, and your average price would then be 15. Okay, so that's what that second number is for the average in, guys. And here's how it looks on the chart here. Let me blow it up real quick. You'll see that this is a visual of the spread. So for pure pullback traders, guys who want to just kind of take advantage of the average worst equity in a particular spread, that would be the green versus red area. And you can see it fits inside the time window of 219 to 44. Average in guys are going to be looking at the light blue and red area. And what you'll see is a couple pieces of data that help visualize the numbers down here. Okay. One is for the average in guy, it shows that the entry level would be about this 10. So right where the green meets the red is the entry level. I mean, this is for the pullback guy. So be looking for this spread to fall down into the 10 or below to get filled. And then hopefully what it does is go from the bottom left to the top right of the chart and things work out. All right. It shows the stop level at 0. It shows the entry or the exit zone also. Okay. So pullback guys, buying it around 10, risking to about 0, looking for an upside level of about 31. Average in guys, okay? In this instance, I'm an advocate of trying to get into this trade on day 0, so on Feb 19, somewhere near the close. And it shows that for the average in entry level, you're looking at this level, which would be right about the close on the 19th of February. So the way you look at this is for an average in guy, you're looking to buy one around 20. And then if the trade is one of those where instead of just starting on day 0 and zips up, okay, it's one of those that, you know, actually ends up pushing down towards the worst equity, one of those particular trades, okay, then you've bought one around 20, you're sitting on that position, and then you'd be looking to buy another one around 10. And what that would do is give an average of 15. So it's buying one at 20, entry level 1 for the average in, buying one at 10 with the pullback guys, gives you an average price of about 15. This is all averages. It's all hypothetical. All depends on what kind of execution you can get, what kind of market it is at the time. But that is the visual. So green, red, pure pullback guys. That's what the risk to reward looks like. Blue, red, that's average in guys. All right. So what does that mean in terms of money? So we've got the average in price going back down to the data here on the row. Average in price of 10 for the pullback guy. And if you look at the first set of numbers under approximate gain and approximate loss, that will coincide with the first number in the entry price zone. So a pullback guy is going to look to pick it up around 10. Okay. Going to be looking to make about $210 and risking approximately 100. Okay. So first set of numbers, buying at 10, looking to make 210, risking about 100. Second set of numbers is for the average in guy. All right. Would end up with a average price of about 15. Would be looking to make about 320 and would have to endure approximate loss of about $300. Okay. So that's how you read the strategy sheet. We've tried to keep it as simple as possible. Actually, what I'm going to do is I'm going to hop into the chart right now just so you can kind of see this in the actual environment, and then we'll leave it there. So let me pop over there real quick. There you go. So let me go to this particular spread, which is the cocoa. All right. Bear with me a moment here. I'm bringing it in. Okay. And here you have it. So again, basically the real-time data here and the one that we use to do the video updates shows the same thing as on the data sheet, the strategy sheet. Green, red is the pullback guy. Blue, red is the average in guy. Benchmark is simply the closing price on day 0 of this particular spread. Okay. So we'll leave it at that. Hopefully you found this to be helpful. If you have any questions or comments, feel free to contact us.